Hey guys, welcome and a very happy festivities to you. This is that time of the year that you see the gold and silver buying at its height, and now there are so many ways of actually investing into these precious metals. Well, to tell you that when you look at this calendar year, gold clearly has given you the best of returns versus other asset classes. And when you look at on where the gold prices were last Dhanteras or Diwali, we clearly have gained nearly 20% from here. But what is the kind of interest that the market is seeing? How much of it should you have in your portfolio? How should you be buying it to get answers to all of those questions? We are now joined by Chirag Mehta of Quantum Mutual Fund. Chirag, hi, happy festivities to you. I really do want to understand on how many people would have really made use of this huge gain, double digit 20% that the gold prices have given to us.
Thank you, Manisha. Wishing you and all your viewers a very happy Diwali and a very happy Dhanteras. So I think the interest in gold is clearly visible. Last few months have been stellar for gold ETFs. And overall, as we see pickup in physical buying, we have seen interest in gold ETFs and efficient products like that going to a very good levels. So if you see last 4 months alone, I've added about 2,500 crores of investments into gold ETFs and gold mutual funds. So we have seen a big increase. So as we've seen that gold give better returns, the interest is only increasing from here on. Given that participation from a participation perspective, also we have seen an increase in number of investors going for gold ETFs. We have reached about 48 lakh investors in gold ETFs now. And if you see last 1 year alone, we have added close to 140, 150 lakh investors into gold ETFs alone, let alone be the gold saving funds. So we have seen a significant increase in investor interest. And we have seen investors at the end of the day bifurcating what is their need for consumption and what they need for investments. And they're clearly making that choice that when it comes to investment, they are going towards more efficient products. And I think this Dhanteras will not be any different. We will see investors taking that call, what is for usage, and they will buy physical jewelry for that. And when it comes to investment, rather than buying gold coins and bars or jewelry for that, they will choose more efficient products like gold ETFs, gold mutual funds, or sovereign gold bonds, be it that efficient purchase that will make this Diwali.
Chirag, what's your sense on the returns as well? Because when you look at that report card in the last 1 year, Diwali to Diwali, the returns have been on the double digit. Anywhere between 17 to 20% is what I saw most ETFs give back to their investors. Are there any redemptions coming, or is it people still buying at these levels?
So last Diwali, we saw some redemptions. There was some pressure clearly from last November to till Feb, March. And that is when we saw outflows from gold ETFs a bit, not any significant, but small outflows that we saw. But last 4 months, we've clearly seen a rising trend for gold ETF investments. As I said, last 4 months alone have contributed much of the last 1 year inflows. So we are standing net 2,500 crores of investments into gold ETFs, and much coming in the last 4 months. So the trend that we see is from outflows or some rebalancing and moving into equities is now changing course, given that we have seen good returns in small cap, mid cap funds in equity markets. They are clearly booking that profits and moving into gold investment kind of products, because there's some skewness when it comes to their allocation towards equities, resulting into that performance that we saw from that pocket. But gold was in some sense, under allocated, and we are seeing that allocation come back. So from here on, given that we see prices move into a constructive zone, because there were clearly headwinds to gold prices over last 1 year with interest rate increasing globally. And that is where, real interest rates were looking a tad better, or, they have been going up to an extent because inflation has been coming down, interest rates moving up. That led to some respite on real interest rates. And that led to some outflows from gold. But now going ahead, much of those headwinds are behind us. We see that, interest rates can sooner or later will start coming down. Maybe over next 6 months, we should see that trend unfold. And that is where you will see more investors coming back into products like gold to increase their allocation. So we see from a price perspective, as we will see continuation of good prices going ahead from here on, at least until next Diwali and further, we will see that investors increasing their allocation to gold to an extent. So we will see with a positive price environment resulting in from uncertainty, the risk aversion, and interest rates moving down. That is where we will see interest increase in gold because we could be staring at a stagflationary scenario. And in those scenarios, usually gold does well, and we will see investors follow that.
So, Chirag, while we've seen 2000 to 2050 rather to 1800 of a range in gold prices in this year, any sense, a back of envelope calculations that you guys could be doing on what is the range that we could see next year?
So yes, last year our view was that it will remain range bound, and it has remained range bound so far in last 1 year. But going ahead, we think that gold prices should be in an uptrend because last 1 year was a year of headwinds. But now we see a positive levers for gold going forward, given that interest rates will come down. We see a clear pressure on buyers of US Treasury bonds because the likes of China, Saudi, etc., are reducing their exposure. Fed is not buying anymore. So there was a pressure on yields moving up to an extent. But I think Fed will have to intervene at some point in time, take a U-turn from their policies that they are pursuing from a tighter monetary stance to a looser monetary stance, because they will have to support the treasury markets and bond issuance from the US government. So we will see that U-turn from the Fed sooner or later, and that should propel prices to a much higher level. So we see multiple levers for gold going ahead when it comes to price action. So first and foremost, the strength in the dollar, the US Treasury yields going up will not be the thing going forward. We see yields coming down, inflation to remain sticky above the Fed mandate level. Those are the things, plus the central bank buying. Central bank buying has been one of the big supports that we're seeing in gold markets. Last year was 1,100 tons. This year, again, it had been or 800 tons already with 1 quarter left to go. So that has been a great support for gold market. So overall, the positives are more. So the risk reward is in favor of gold. Gold prices should move up from here on. And I think as prices move up and show more constructiveness, we should see buyers coming in. Also, if there is any risk aversion because of slowing growth, I think that should also bring along a set of buyers into gold from risk assets. So given the view is very constructive, the back of the envelope calculations can be plus or minus, but the trend clearly is up.
And that is good to hear. So clearly, if you bought gold or silver last year, you're sitting on hefty profits, and that continues to be the case right now as well. We have seen more investors come into this for, and as Chirag also said, it is slightly underinvested when you look at it as a financial product, and that perhaps seems to be getting corrected right now. Thank you so much, Chirag, for joining us. Happy festivities to you yet again.
Thank you, Manisha. Wish you the same.